In this video, we talk about 6 financial assets that the rich rarely, if ever, buy, and the poor often do. Coming up next on Holy Schmidt.
Holy Schmidt!
There are 6 financial products that get sold hard to retirees every single day. The wealthy usually turn these down. Others sign the dotted line. We're going to talk about what the wealthy know and what the sales pitch leaves out. Yesterday, I had an experience that many people watching this video have probably had, and candidly, I felt a little bit yucky about it. I was talking with a friend, and by chance, I asked them about what they did for work, and they started to talk about it. And I inquired further as to what types of products, financial products, this person sells. And that was all that they needed. They went from being a friend to a predator in about 30 seconds. Now I had a problem. In fact, I had 2. The first was that I realized shortly after asking him about the product that it was a pretty scammy product. And the second was I actually invited him in by asking about the product, and I couldn't shut the door because he put his foot right in the way, so to speak. To make matters worse, I'm told I can be very direct, and when someone pitches me a product that is bad, I have no problem telling them that. I have no problem even shaming them a little bit because they're pitching something that nobody should own. But in this situation, I wanted to remain friendly with this person, although candidly, I was becoming less and less interested in being friendly with this person after this was all over. So I listened to the pitch and I politely said, no, this isn't for me. And he kept pushing and pushing. And so I probably ended the friendship, but what I said to the individual was, I can purchase this for about half the cost if I break it apart into 2 or 3 different products. Why would I want to combine them all? He responded with something I didn't completely understand, and I said, I'm sorry, that doesn't even make sense to me. He politely ended the conversation and walked away. I doubt we'll talk again, unfortunately. Now, gang, there's a shadow industry built around retirement, your retirement. And there are products that are designed for people that aren't really good for anybody or rarely good for people. They're products that have guaranteed income in the title or family memories or tax-free growth in them, and they're vehicles that you might not have heard of before. So they sound interesting, but there's a reason that you haven't heard of them before. Wealthy retirees almost never buy these products, and not because they're wealthy. It's because what comes with wealth is often financial acumen, an understanding of how things work. And they know these products, they know how bad these products are, and they avoid them. Today I'm going to walk you through 6 of them, why these 6 fail, and what to do if you already own them. Now there are 2 things to keep in mind before we start. The first is that they're not universally bad. There are specific situations where they might be appropriate, very specific situations, but they're not universally bad. The second is if you already own one, not to feel a flush of regret because you might be the person who the product is actually right for, but it's important to know the answer to that question. All right, let's talk about number 1, the most obvious one. You probably have already guessed it, timeshares. The pitch is almost always emotional. It's sold as memories. It's sold as a family vacation guaranteed for life. It's sold as vacation ownership. But frankly, none of these pass the financial test that makes it a viable product in most circumstances. First, like the magician who tells you to look here when something's happening down there, there's something else happening besides the upfront costs and the exorbitant financing fees. And that is the annual maintenance fee. The annual maintenance fee in timeshares goes up on average 4 to 6% per year. And they're almost always required. I've never heard of a timeshare that doesn't have an annual maintenance fee, and special assessments if the resort needs some upkeep. If they're putting in a new lift, for example, at a ski resort, and that runs $30 million, well, if the resort has 2,000 condos, that's going to be split across 2,000 condos. And by the way, you have no vote. You can't say no to a new lift or new buses or the CEO of the resort's salary. That's not within your purview, unfortunately. And then there's a resale market, or the lack of resale market. Timeshares are the only assets that I know of that have been sold on eBay for $1. Now, why do they sell for $1? Because the owner wants to get out of the obligation of the annual maintenance fee. And there's one more wrinkle that you need to know about. This maintenance fee generally stands the test of transfer in an estate. So if your kids get the timeshare and they don't know that they're also taking over the obligation of the annual maintenance fee, it'll be a big shock when they decide that they want to sell the timeshare or they just don't want to pay the annual maintenance fee anymore. So what do the rich do instead? They rent. They don't buy the timeshare. Let me give you some numbers. I looked these up for this video. A timeshare in a ski vacation resort costs about $50,000 for a popular week. Say week 7, that's President's Week. And the annual maintenance fee might be about $2,500 per year. And for that, you get lift tickets and you get the unit for 1 week a year. So think about this for a second. $50,000 plus $2,500 per year. Take $50,000, divide it by 20, and you have $2,500 in today's dollars, plus $2,500 for the annual maintenance fee, $5,000 for a ski vacation. Now that seems sensible, except for you have to take the same vacation year after year after year. And after 15 or 16 or 17 years, that becomes not so attractive. Also, that maintenance fee continues to go up year after year after year. Now, if you own one and you want out, you have 3 paths. A deed-back program through the developer if they offer one, a certified timeshare exit company, but be careful, many exit companies are scams on their own, or talk to a real estate attorney about disclaiming the heir obligation in your estate so that they don't have to take the burden of the maintenance fee. The second point is very sophisticated, and it gets pitched to wealthy retirees quite frequently, and that is life insurance. It's permanent, but you can look at it as an investment. And let me make a distinction up front. Term life insurance is different than what we're talking about here. It's cheap, it's effective, it gets the job done, and lasts for a period of time that you need the coverage, and then expires. So to be clear, we're not talking about term life insurance. It is quite useful in certain circumstances, particularly protecting young children. We're talking about the permanent versions: whole life, indexed universal life, and variable universal life. 3 products with the same DNA when they're sold as retirement income tools. And the pitch sounds compelling because the tax mechanics can work. On paper, the cash value grows tax deferred. Properly structured loans against the policy come out tax free. If everything holds up, the math is real. The problem is that everything needs to hold up, but let me show you what happens in practice. In the first 5 to 10 years, a significant portion of your premiums go to commissions, and they go to policy expenses, not to the asset value of the policy. And in fact, the first year commission to the selling agent can often exceed what you pay as a policy premium in the first year. 70% to 110% of your first year premiums is not uncommon. And to be really clear about this, that money doesn't come from thin air. It comes from your premiums paid, which means those same premiums aren't building a cash value in the product. Second, in the universal life and the index universal life policies, the cost of insurance, the cost to insure the policyholder, goes up as the person gets older. The policy gets more expensive to keep alive in the years it's supposed to be delivering income. That's the opposite of what the illustrations usually show, by the way. Third, the policy illustrations often show credit ratings and capitalization rates that don't materialize in real life. Fourth, and this is the point that a lot of retirees don't see coming, tax-free distributions only work if the policy stays in force. If a heavily borrowed policy lapses, a major tax event can occur. The gain in the contracts become a tax event, and usually a very large tax event, at the worst possible time. So a strategy to give you tax-free income in retirement could and often does give you a very large tax bill instead. And there's one more variation worth mentioning by name: premium finance life insurance, borrowing money to pay for a permanent policy. This strategy depends on the loan rate, the credit rating, the cap rate, and the cost of insurance all behaving correctly for decades. It works in an illustration, but it falls apart when interest rates do something unexpected. In fact, the SEC has brought enforcement actions against insurance companies and agents, for that matter, for selling this product incorrectly. So when is permanent life insurance genuinely defensible? Well, frankly, for situations that most people never encounter. Estate liquidity for taxable estates above the federal exemption level, special needs trust funding, and business buy-sell agreements. Those are the real uses for the product, not as a primary income vehicle. Now, if you already own one, you're not alone. If you wonder where you stand, ask your insurance company for a current in-force illustration. Not the previous illustration that you had before, but the current in-force illustration. Unfortunately, the numbers are usually meaningfully worse than the original numbers that you were shown. Gang, if you're doing finances on a spreadsheet, you're doing it the old-fashioned way. On this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software, the personal financial planning software that I personally use. Bolden will let you model different outcomes for different worldviews, depending on what you think is going to happen in the future. And it will give you different case scenarios, best case, worst case, base case, I suppose. If you'd like to try it free for 2 weeks, use our affiliate code. Simply go to go.bolden.com/Schmidt. You can try it free for 2 weeks, the full featured software, free for 2 weeks. After that, it's $12 a month paid annually. Now, the third one is one I want to handle carefully because the headline is often wrong, and that's reverse mortgages. First, let me tell you that I'm not going to tell you here today that all reverse mortgages are wrong, because they're not. The federally insured version, called an HECM or home equity conversion mortgage, can be the right tool in a narrow set of circumstances. The problem is that the circumstances are narrow, but it gets sold broadly as a solution for any cash flow shortage when other options might be available. So when potentially is an HECM appropriate? For a late retirement homeowner with significant equity, no heirs, and prioritizing the home, looking to age in place, and other retirement expenses are already covered. You would use it as a line of credit for unexpected expenses, not as a way to fund a lifestyle. Those specific set of conditions are real. A lot of people experience them. And if you're one of them, an HECM might be right for you. Where it goes wrong is using the product incorrectly, funding your lifestyle when other forms of equity are available first, or if you pull a lump sum out to invest. So basically what you're doing is you're using your home equity to put leverage into investments and in the equity market. Some people have actually used their HECM to buy a more expensive property when staying in their current property was the thing to do. The math doesn't support, usually anyway, those specific case scenarios, although there are others I could probably list as well where it just doesn't make sense. Those are the most common. And by the way, the costs associated with a reverse mortgage, they are very real. Origination fees are capped by HUD, but it's $6,000. There's a mortgage insurance premium up front of 2% plus an ongoing premium of 0.5%, so 0.5%, ongoing. Add an appraisal, title fees, counseling fees, and now you have several $1,000s of additional fees that you're going to pay on top of the costs that I just talked about. And then the interest accrues and compounds for the life of the loan, basically until the house is sold. And heirs, by the way, inherit the obligation, not personally, but what it means is that after 10 or 15 years, the home could actually be worth less than the loan on the home. And so the estate, if they go to sell the home, would need to walk away, because in that instance, either the heirs pay for the underage or the estate just lets it go. Now, let me just say again that the reverse mortgage, the HECM reverse mortgage, isn't necessarily a bad product. I just don't like the way that it's pitched. Oftentimes, you'll see celebrities on TV talking about the great result from a reverse mortgage. They pitch it like free money, and of course, it's not. And by the way, if you already have a reverse mortgage, get 3 numbers from your service provider: the current loan balance, the current home value, and the projected loan balance in 10 years. The math is generally more clear than the sales conversation would suggest. Next up, a variable annuity with a living benefit rider. Let me explain. This is one of the most expensive fee-laden products in the entire market, and it's sold under something that people generally understand, or at least they think they understand: annuities. And an important distinction: not all annuities are bad under the right circumstances, An SPIA, a single premium immediate annuity, works under the right circumstances. Also, an MYGA, multi-year guaranteed annuity, which is essentially a CD wrapper inside an insurance product, can work for the right portion of a retirement portfolio. These are not the trap, usually. The trap is variable annuities with living benefit riders. The riders go by very convincing names, like a GLWB, Guaranteed Lifetime Withdrawal Benefit, or GIMB, Guaranteed Minimum Income Benefit. The pitch is that you get market upside using subaccounts with a guaranteed income floor. But here's what actually goes on inside that contract. There are 4 fee levels happening. First is mortality and expense charges. That's 1 to 1.5% per year. Administrative fees run about 0.25% per year. Subaccount fees are 0.5% to 1% per year. And the rider charge for the guaranteed income, 0.85% to 1.5% per year. Add it all up, and the annual costs run 2 to 4% per year every single year. 2 to 4%. For comparison, a low-cost exchange-traded ETF runs between 0.3% and 0.2% per year. So what we're talking about here for the annuity is 12 to 100 times more expensive in terms of fees. The second is what the guarantee actually means. Most people, when they hear guaranteed income, think that they're protected. They're not. The guarantee is a guaranteed stream off of a separate accounting base, not the account value itself. The insurer keeps paying the stream from their reserves until you die, but what's left to the heirs is sometimes zero, or very little anyway. And had all of those fees not been in there, the number would have been quite a bit higher. And then if you decide you want to get out early, there's a pretty stiff surrender schedule. It starts off between 7 and 10% and then goes down annually from there. Now, what frustrates me as a CPA and knowing the numbers is that there's a more simple product which accomplishes the same thing. An SPIA, we talked about it earlier. Now, let me give you a comparison. Let's take $500,000 at age 70 because it's a nice round number. A variable annuity with a 5% GLWB rider would guarantee you about $25,000 per year for life. The same $500,000 in a SPIA at age 70 currently pays $35,000 to $40,000 per year for life, $10,000 to $15,000 more per year for life. The reason that there's a range is because the exact amount that gets paid depends on interest rates or gender and whether you're talking about single or joint. If you actually want guaranteed income, the SPIA is probably a better tool. If you actually want market performance, then a low-cost ETF might be the right tool. The variable annuity with a rider charges you for both and doesn't deliver either very well. When are these products defensible? Well, for retirees who would panic sell, I suppose, that's one. Tax deferral inside a high-tax taxable account can sometimes justify the cost, but rarely. Maybe creditor protection in certain states for a very narrow list of professions, I suppose. But these cases are rare, and it's not sold solely for people in those circumstances. If you own one, pull the contract and then identify all 4 cost layers and then ask the advisor to tell you what those costs are in dollar terms, not percentages. And then get an SPIA quote for the same amount of money to see what guaranteed income looks like in that scenario. The next point is crypto in retirement accounts. Now, this one's newer, but it's increasing in popularity. Now, let me be clear. This is not a video about whether crypto is a legitimate asset class or not. This is about whether crypto belongs inside a retirement account specifically. There are real retirement account specific traps that the person selling you this product doesn't normally disclose. They might not even know themselves. The pitch is that you get tax-deferred growth on high upside assets. And on paper, it sounds great. But here's what the pitch leaves out. The first is custodian risk. What is custodian risk? There have been cases of custodian failures and fraud inside self-directed IRAs. When a custodian fails, your assets can be held up in bankruptcy for years. And unlike a traditional brokerage account where SIPC insurance protects you against a failing custodian, those protections don't generally extend to crypto. The second is what's called prohibited transaction risk under the tax code. Let me explain. The IRS rules around what an IRA can hold and how it can hold it are strict, and the guidance on crypto specifically is not fully settled. Some tax practitioners tell you that holding the keys to your crypto in an IRA account create problems. And this is still unsettled, but if the IRS deems crypto in an IRA to be a prohibited transaction, then you could have a very large tax bill all at one time, and potentially a 10% early withdrawal penalty if you're under 59 and a half. Finally, structured products. And the pitch on these sounds too good to be true, and that is because it usually is. Let me explain. You'll see them under names like principal protected notes or market-linked CDs as an example. The pitch is some version of market upside, market downside protection. Get the gains of stock without the losses of stock, they say. That's the dream, and that's what the product is designed to look like. Now here's what's actually inside. First, caps on upside. The brochure says 100% market participation. The fine print says, but that's capped at growth of 8 to 10% per year. So in a year when the S&P 500 is up 20%, 25%, you get 8. Second is the confusion, unintentionally or otherwise, about the difference between loss and buffer. And this relates to how much you can lose if the market crashes. A 10% buffer isn't the same thing as a capped loss of 10% if the market crashes. It means that the first 10% of losses are absorbed by the issuer. The rest is covered by you. In other words, the buffer is not the same as the floor, even though the marketing suggests that it is. Third is the issuer credit rating itself. Structured products are unsecured obligations of the issuing bank. You're not investing in the market, you're loaning money to the bank, and the bank in turn is paying you a return based on what happened in the market. If the bank fails, your principal protection fails with it. This happened to Lehman Brothers in 2008, and it wiped out billions of dollars of structured credit products that people thought were safe. And then they're illiquid. Most of these products can't be sold, there isn't a buyer, and so you have to hold them for 5 to 7 years. If you like this video, check out that video. Most retirees don't know that this Roth conversion window closes in 2028. Also, don't forget to check out Bolden, free for 2 weeks, full featured software. Simply go to go.bolden.com/Schmidt, try it free for 2 weeks, and if you want to keep it after that, it's just $12 per month, paid annually. This is Jeff Schmidt, and I will see you in that video right there.